Restrict cash. Physically, these actually are cash or money, but in terms of financial reporting, these cash has restrictions. In other words, they lose the liquidity as what they are supposed to have. So this cash is restricted in some way that is not available for current use. This cash lose its liquidity. The example includes the firm may set aside some of its money to an account for the future large purchase or large investments. So these are money deposited in the banking account, but this cash just stays there for a specific purpose. In this example is for future planned expansion. Another example is contractually imposed. This happens in a lot of borrowing contracts because the lender requires borrowers to set aside fund for the debt. Depends on the debt. Okay, if the debt is non-current, the cash is actually restricted cash and will be reported in the non-current assets. If the debt is current, then this restricted cash will be reported in the current assets. For different restricted cash, they can be reported in either current and non-current assets parts, but not cash or cash equivalent. These cash are reported in the statement of cash flows, but not in the cash and cash equivalent account. When we talk about the contractually imposed example, so here is another term, compensating balance. So this is amount that compensates the bank for granting the loan or extending the line of credit. Under this arrangement, the borrower should maintain a specific amount in an account. This account usually is in a low interest or non-interest bearing account. This amount is restricted. And this amount usually is a percentage of total committed amount. Because of this, the borrower actually borrow less. This will increase the effective interest rate than the rate on the debt. This example provides a more clear illustration. So a borrower borrows $10 million from the bank. If the interest rate or state rate was 12%, but actually this is not effective interest rate this company paid. Also, according to their negotiation, the bank requires a compensating balance which represents 20% of the debt held in a non-interest bearing checking account, actually in the bank. These $2 million was from the borrowed fund, but they lose their liquidity. Although the company intend to borrow $10 million, but actually there was only $8 million available. So this is actually the actual principle. Interest is calculated based on the $10 million instead of $8 million. So interest is 10 million multiplied 12%. The annual interest is $1.2 million. The effective interest rate is actually 1.2 million divided by 8 million, 15%, which is greater than the state rate. Why the bank requires a compensating balance? This is like buffer or protection to the banks. When you buy a house or car, it usually has a down payment. The down payment actually is a protection to the lender, the banks. Okay, so here, just following the prior example, we can calculate the effective interest rate. We just need the actual interest which is determined by the state face value of the debt multiplied 10%. So that's interest, while the principal is the amount after we subtract the compensating balance. Compensating balance was 3 million, so the total principal to calculate EIR will be $10 million. So finally, the effective interest rate is 13%, which is greater than 10%.